Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely is Phil Mackintosh, Chief Economist at Nasdaq, to review how policymakers and investors are modeling out the global economic impact of the coronavirus. And today we're going to focus on earnings. They might not have been as bad as feared, but Phil, before we get into that, we certainly have to discuss what happened with oil futures yesterday.
Yeah, it was a day that will live on in infamy. The oil futures price closed well and truly negative, having sold off already 40%, I think, by the time we were talking yesterday. And I think what's important to remember here, I mean, we don't know everything, but we know a lot of things already. If you look at the price of Brent crude, it didn't sell off nearly the same way as West Texas Intermediate. If you look at the West Texas Intermediate front month future, it was the one that sold off, not the next month's future. So this is clearly a futures supply and demand problem for a specific futures contract, not representative of the oil market as a whole. The reason that we use futures prices to tell us what the price of oil is because the spot market really isn't that active. And so it's not like a stock market where the price of Apple is always bid and offered with a 1 or 2 cent spread, and we know exactly what the value of Apple is at any instant. The spot price of oil is much harder to lock down. There's all different grades of oil. So the futures prices tend to be used as a proxy for the spot price because they're traded constantly. But what happened yesterday to oil was a little unusual. I think the problem with oil futures is you take delivery of oil. So if you're a trader who is facilitating the market and you end up net long with a day to go on the contract, the last thing you want is to get to the end of last night and have a long position because you're actually going to receive oil in your front door, and you can't afford to do that if you don't have somewhere to store it. So what happened yesterday was effectively people realizing they had to pay somebody else to be able to store the delivery. So in that sense, you would pay somebody to take the contract from you. Kind of rational, but not across the board sell-off in oil, that's for sure, which was super interesting. A lot of people are talking about whether it was an ETF that caused it. It doesn't actually look like that. So when you look at some of the really big ETFs in the market, a ticker like USO is actually, it's been seeing net inflows. Its price yesterday was pretty stable compared to the sell-off in oil, and its price today is reasonably stable as well. The reason that we sort of look straight at ETFs is because when you want to expose yourself to oil, it's typically as a fund, you don't have storage facilities either. So you use the future plus cash to create that exposure. And when you buy the futures, every time you get to the end of the month where the future is expiring, you have to sell that month, roll into the next one. And so there is contango and a whole lot of other things that we could talk about that affect oil futures markets and oil futures funds. But nevertheless, you have to sell the front month, roll into the next month. And so that essentially is what we saw happen yesterday. But looking at the fact that the USO and a lot of the oil ETFs haven't gone broke overnight and are continuing to trade at relatively stable prices, it doesn't look like the ETFs were to blame.
All right, moving along to COVID data. It looks like there's some positive news on the overnight and the downtrend is still in place.
Yeah, I mean, the last couple of days have probably made the downtrend look a little bit more firmed up, which is great news. Great news for the US cases and great news for the global cases. There is news coming out of Germany that they're starting to open up already. There's some multi-pronged plans in the US and in the UK, which don't have start dates before May 11, but they do have like 3 steps where we start to go back to work. We start to open up restaurants, maybe with every second seat held, so you can't have people sitting too close to each other. And then in the third phase, provided we don't get a reacceleration of cases, kind of getting pretty much back to normal, potentially without the at-risk people, so older people with preconditioned health concerns, back to normal, but basically everybody else back to normal. So there's plans being put in place, and Europe is already starting to open up. We'll hopefully see from their data whether this is successful or not. And I think some good news that came out overnight in terms of testing and just the results of the testing. There's a couple of different studies, one done in Santa Clara and one done with the maternity ward admissions in New York, which show that a lot more people have had COVID or have got COVID than we realize. So there's a lot more asymptomatic cases than you would think, which also means a lot of people 3 weeks later have immunity. So it's possible that COVID is not as bigger mortality threat, so the death rate is lower, but also a lot more people are already immune going forward. So that's good as well.
Yeah, that certainly is encouraging. Let's wrap up with earnings here. Obviously, in the thick of it this week and certainly into next week, where we have the larger S&P 500 and Nasdaq 100 companies reporting over the next 2 to 3 weeks, but it might not be as bad as expected.
Yeah, so we are, as you said, just starting earnings season, and we've been seeing the forecast, the bottom-up forecast, being wound down, like we talked about a couple of days ago. But some of the charts are indicating that people aren't winding the earnings down quite as aggressively as 2009, which was the credit crisis. And obviously, the credit crisis, I mean, totally different animal. But banks going broke, people losing houses, the flow on a dry up of credit, lots of people lost their jobs with no real prospect of those jobs coming back for quarters at a time. It was a prolonged downturn with a lot of bankruptcies. The theory is that coronavirus 3-month deal, we are forced to sit at home. It's kind of like a long summer or a big long winter snowstorm, and then we all can go back to work and start spending just like normal. Some of the data out of the 1918 Spanish flu shutdown show that that's how that worked. It was a relatively short but deep recession. And so in that case, it probably won't hurt full year earnings. And that's what some of the forecasts are showing as well, is that although it's probably going to be a deep recession in a very short period of time, it might not have such a big impact on earnings, which obviously flows through to valuations of stocks.
All right, Phil, as always, thanks so much for joining me.
Thanks, Jill.
All right, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.